Friends, today's topic is debt to equity ratio. Debt to equity ratio, commonly known as the DE ratio, is one of the most important financial leverage ratios used in credit appraisal. It tells us how much of the business is financed through borrowed funds compared to the owner's own investment. The standard formula is total debt divided by shareholders' equity or tangible net worth. For example, if a company has debt of 80 lakh rupees and equity of 40 lakh rupees, its DE ratio is 2 to 1. This means that for every 1 rupee invested by the owners, the company has borrowed 2 rupees. Generally, a lower DE ratio indicates a financially stable business, whereas a higher ratio suggests greater financial risk. To understand the DE ratio, we must first understand its two components. The first is equity, which represents the owner's investment in the business. It includes paid up capital, reserves, retained earnings, and tangible net worth. Equity acts as a safety cushion because it absorbs business losses before lenders are affected. The second component is outside liabilities, also called debt. These include bank loans, term loans, working capital borrowings, creditors, and other external obligations. Together, equity and outside liabilities finance the company's assets. Therefore, a balanced mix of debt and equity reflects sound financial management. For a processing officer or credit analyst, the DE ratio is an essential tool for evaluating the borrower's financial health. A high DE ratio indicates that the company relies heavily on borrowed funds. If business profits decline, such companies may face difficulty in servicing interest and loan repayments. On the other hand, a lower DE ratio shows stronger owner commitment, lower financial leverage, and better repayment capability. Generally, a DE ratio below 1 indicates a strong financial position. A ratio between 1 and 5 is acceptable in many industries, while a ratio above 5 requires careful analysis. However, the acceptable level always depends on the nature of the business and the bank's credit policy. Therefore, the DE ratio should never be viewed in isolation. It should always be analyzed along with profitability, cash flows, liquidity, and debt servicing capacity before taking a lending decision. Thanks for watching.